Howard, thank you for taking the time to join me today.
It's a pleasure to be here.
I know you have a busy schedule, and as I said, I've read everything you've written over the years, and I wanted to thank you personally for sharing all those thoughts, because they've been hugely instrumental in me being able to build my own framework. And that's a lot of what I want to talk to you about today is how you think as well as what you think. And to start, I just want to take you back to 2005, 2006, which was a time when you were making some pretty aggressive moves at the time with Oaktree's portfolio, and talking about them in terms that had a lot of people kind of thinking, is he nuts? Well, this is some pretty dramatic statements to make. So can you just take us back to that point in time and talk about what it was you were seeing and what you felt you had to try and prepare for?
What we want to know is when psychology is too high and optimism is too high, and as a consequence, behavior becomes imprudent. When behavior is imprudent, then asset prices go too high based on favorable expectations, and the world becomes a risky place. We actually made the best purchases we ever made in the summer of '02 in the world of distressed debt, because we had the meltdown of the telecoms who had over-borrowed to build fiber, and we had the scandal companies. That was incredible, but the world bounced back from that. Actually, it wasn't an event in the world, it was an event in a little corner of the credit market. But it came back, and everything was hunky-dory by '03 and well into '04. And it just seemed to go on from there. And to me, the most important thing was that in '05, '06, my partner Bruce Karsh and I spent the whole day complaining about the deals that were getting done. Any crazy deal could get done, you know? When investors are practicing the willing suspension of disbelief, it's dangerous. And in a prudent market where people are appropriately skeptical and risk averse, there are deals that can't get done. But in that environment, they were. And so we just took that as a great sign of danger. And so we sold a lot of assets, and we liquidated some large funds we were managing and only replaced them with small funds, and raised the standards for the investments we would make. And most importantly, at the beginning of '07, our distressed debt funds had always been $1 billion or $2 billion, and at the beginning of '07, we set out to raise a reserve fund that would invest if a crisis came along. And that fund eventually reached $11 billion by March of '08.
Now, this was about the time when you wrote Race to the Bottom, which is probably one of your most widely circulated memos.
That was in the first quarter of '07.
Yeah. You know, this was, I'm fascinated in what it takes to go from talking about how crazy the market is and how badly all these crazy deals get done to actually doing something about it, because it's so easy to sit there and say, well, this is crazy. And it's still crazy 3 months from now. How do you galvanize yourself to take action and say, you know what, we're going to go out on a limb here and actually do something about this?
My experience, for some reason, has enabled me to not be afraid of being wrong.
Right.
I'm always conscious of the opportunity to be wrong, but if I hold an opinion and if Bruce agrees, then I think the greater risk is not taking action. So, you know, and the other thing is, by that time, you know, I'd been in this business almost 40 years, and I'd seen a lot of cycles, and the cycles do tend to rhyme, and we thought we were seeing the heated part of an upcycle, which is a good time to take defensive action. So the Race to the Bottom talked about the fact that the securities markets and the lending markets are auctions. And the opportunity to buy a security or lend money goes to the highest bidder. And if you think about an auction for a painting or something like that, the winner who pays the highest bidder is actually, if you turn it around, he's the person who's willing to receive the least for his money. And so if you are making a loan and there's a competition to make that loan, the opportunity to make the loan will go to the person who receives the least for his money, the least return and the least safety and the least structure. And when too many people have too much money and they're too eager to put it out, then the bidding goes too far, and the winner of the auction is actually a loser,
Right.
because he does something imprudent.
But this is fascinating because when I read that memo, it was so simple, but I mean it hits you like a ton of bricks when you look at it in just a slightly different way. But again, this was first quarter of '07.
Yeah.
So you were still quote unquote wrong for a year and a half.
Right.
So how do you manage that in terms of, because a lot of people have been expecting markets to stumble for a while now, and they haven't. And we'll talk about the Fed and all kinds of stuff, I'm sure, in a little while. But how do you manage that expectation and then something you're so sure about not happening?
First of all, I'm never sure.
Right.
Don't use that word with me. Everything I do is with trepidation.
Yep.
Henry Kaufman said there are two kinds of people who lose a lot of money: the ones who know nothing and the ones who know everything. I hope never to be either. I use a lot of quotes and adages in my memos, as you've seen in the book and when I speak. And the first of the great investment adages that I ever learned in the early 70s was that being too far ahead of your time is indistinguishable from being wrong. But you have to live with that.
Yeah.
Because in our business, if you're wise, you have a sense for what's going to happen. You never know when. And the people who think they know when tend to get into big trouble. If you accept all of that, what it says is you have to think of what you think will happen. You have to take action, but you have to be willing to wait that long period until it turns out to be correct action.
I mean, you also said what a wise man does in the beginning, the fool does in the end, which is, again, another way of saying the same thing.
Yes.
But,
well, the wise man is early.
yeah.
And he has to wait.
But waiting and convincing your investors to wait is another level altogether. I mean, you obviously, with your tenure in the industry, your track record, you are given more leeway than other managers, perhaps, which is perhaps the greatest advantage you could have. But still, you have to manage those conversations with people and manage the fact that, I guess on a portfolio level, you have to manage your risk and manage your bleed while you're trying to wait for this scenario to unfold. But how do you manage those conversations with investors who are saying, hey, Howard, you said we should be worried about this. Look, everything's great, because everything is great optically.
Well, we don't have that conversation too often, but if I had it, I would say, I didn't say it's going to happen right away. That's the key. Overpriced and going down tomorrow are not synonymous.
Sure.
And you know, Grant, that in our business, many things are overpriced and become more overpriced and more overpriced and more overpriced. And that's how you go from a bull market to a bubble. Right. And I don't know, first of all, we have the confidence of our investors. Secondly, the money we're talking about is in closed-end funds. Yep. Where we don't have to worry about people withdrawing. So that's you talked about having the confidence of your investors. The greatest advantage in this business is having 10-year money. Yeah, look up Capitalism. Because, given the errors of the herd, the pressure to sell is always greatest at the bottom. And if you have 10-year money, you don't have to succumb to it.
Yeah, sure. Well, cycles, you mentioned cycles. I know you're a great student of cycles, and they used to be so important in markets. Everywhere you look, whether it was the human cycle, whether it was the market cycle, credit cycles, everything seemed to have a rhythm, and it made investing a lot easier because you could at least have some sense of how these cycles would turn. That seems to have changed significantly in the last 15, 20 years. You're shaking your head there, Steve.
I don't agree with that. I mean, I think that if you talk about 20 years, if you came in this business 20 years ago, you have seen two profound cycles. You had the TMT bubble and crash, and then you had the mortgage bubble and crash. And I think that maybe they weren't predictable, but I'm not sure they ever were. But
do you think, would you? I mean, I wouldn't classify those as cycles. I kind of look at them and think they were both attempts at cycle turns that happened quickly in kind of short order in small corners of the market, and then got squashed quickly by Fed policy.
Well, they were market cycles, bubble and crash.
Yeah.
They weren't economic cycles
in
the traditional sense. And in the last 20 years, I think that developments in the financial world have taken over in importance from developments in the rest of the business world. The mortgage crisis, for example, the global financial crisis, had almost nothing to do with the economy. I think what you were trying to get at is the fact that if you go back 30, 40 years, the declines in the market were produced by declines in the economy.
Exactly right. Yep.
But the global financial crisis, the bubble had little to do with the economy, and the crash had, I think, nothing to do with the economy. It happened to bring on the worst recession in a long time, but it wasn't caused by a recession. It was caused by some funny thing that some people were doing down on Wall Street.
So how do we get into that stage, you think, where it should be that the stock market responds to the economic cycle and recessions cause stock market crashes, but we seem to have flipped that?
I think the financial activity became excessive. I mean, finance, investing, financial engineering, whatever you want to call it, kind of took over in importance from what you might call the industrial world sometime in the last 25 years. And I guess I haven't thought about this, and your question prompts me to do so, which is great. But I guess what we now have is the tail wagging the dog. Yeah. The tail is finance, the dog is industry. Financing used to serve industry, and then it became a thing in its own. I think that derivatives, the concept of derivatives, had a lot to do with it. If you go to a football game, and the game is played down there, but you're sitting here and you're making side bets with the guy next to you. You're not contributing anything to the game. And that's what derivatives is. It's side bets on the economy and business activity. It doesn't do anything it doesn't contribute to society. Now, the people who are in favor of derivatives say it permits people the transfer of risk, which has a place. But I don't think it's all necessary to accomplish the aims of society. I need more time to think it through, but my reaction is that it was, you think about the mortgage-backed securities, I think that they took a bunch of PhDs from Harvard and Princeton and places like that, and MIT, and they sat them around a table, and the boss comes in with a box full of mortgages, and he dumps these subprime mortgages on the table, and he says, okay, prize to the winner who can configure these so that the largest percentage of the result is AAA. Yeah. That's called financial engineering, quant behavior. Yep. But it doesn't do anything for society, and in fact, in this case, it hurt. For sure. It's really been difficult for these last, it seems 25 years maybe, right, to put aside the Fed and try not to point the finger at them for every single ill. Yeah. But you can't help but go back to '87 in particular and look at what happened there in October and the response to it, and think at that point in time something materially changed, and something became very, very clear. And you've written about this extensively, but it became very clear that the Federal Reserve were hostage to market fortunes. And it wasn't so clear then, but just this week, right, we've had perhaps the greatest example of that we've seen. Right. Jay Powell's U-turn. Yeah, well, it's very challenging to run the Fed because you have three masters. For decades or centuries, your job was to manage inflation. More in the last few decades, they also added the job of supporting employment, which of course is in opposition to controlling inflation. And now they've thrown in the third, which is to make sure the market goes up. And I think that's very troublesome. So I don't even know if they've thrown that in. It seems to me that the Fed have said, hey, we'll take that. We'll take that. But they really have created a rod for their own back here. Well, Alan Greenspan saved the markets a few times, and then that gave rise to the belief in the Greenspan put. And everybody figured, well, if anything goes wrong, the Greenspan will just bail out the economy and the markets with some extra liquidity, so we don't have to worry about the risk of the things we're doing. And of course, that's called moral hazard.
Yeah.
And it's a terrible thing.
But the Greenspan put begat the Bernanke put, which begat the Yellen put. And when Powell came in, there's a transcript of an FOMC meeting from October 2012 where he was newly on the board, I think. And he talks about this moral hazard. He talks about the market's reaction to the Federal Reserve. And he essentially lays out the fact that he understands exactly the transmission mechanism. He understands what message they're sending, what they're doing, what the market believes and what the market wants. And so when he came into the role, I foolishly believed that, okay, here's a guy who gets it. But either way, if he caved or didn't cave, at least we'd know that it's all about keeping the market up or it's all about reality. And I think we found out this week that it's all about the stock market. So does that clear the decks?
Well, maybe when you're posing that, I was thinking, so what you're doing is you have the game, you have the guys in the stands,
yep,
and you're changing the game for the benefit of the bettors.
Yep, that's exactly right.
Right, and that's not a good idea. The important thing is to keep that the game is played well, and the investment markets can take care of themselves.
When did we get to the point where a recession is something that has to be avoided at all costs?
Yeah, well, it's a big mistake. In one of my memos, post-mortem, for the global financial crisis, I talked about forest fires.
Yep.
And good forest management, you permit there to be fires once in a while. And if there are fires of moderate size, occasionally it burns out the fuel, and then you don't get the one big one. Right. Same thing, in my opinion. And the fluctuations of the economy are natural, in my opinion, and should be permitted to occur.
Yeah. And
if you try to forestall them, then when they happen, I don't think you can forestall them forever. And when they happen, they're bigger.
So when you look across the landscape,
and the attempt to forestall them creates moral hazard.
Yeah.
That's the key.
But when you look across the landscape at this kind of construct that we've built ourselves within the Federal Reserve or the central bank controlled world, they can't control this forever, surely.
Right.
There must come a point where things get out of hand. Do you sense, going back to that original question about 2005, 2006, do you see any similarities in what you're seeing, what's starting to make your spidey sense tingle?
Not similarities in the sense of specific things repeating.
Yeah.
But I have felt that because people were traumatized by the Great Recession, the recovery has been the slowest one since World War II, and that has kept things moderate, which meant that we would certainly have a recession one of these days, but it would be moderate. It wouldn't. When you don't have a boom, you don't have to have a bust, in my belief. But now, between the tax bill, which was a shot of adrenaline into, in my opinion, an already healthy patient, and then the possibility that we're going to see a Powell put in action, I think that we may get to highs that lead to lows. I think that when I was writing, I'm a believer in cycles. I believe they always have occurred. I think I understand why, and I think they always will occur, and I try to study them. And then when I kind of got to the end of writing the book, I said, well, why do we have cycles? If the market goes up 10% a year on average, why doesn't it just go 10% every year? Why? And in fact, it almost never goes up between 8 and 12. So the average is not the norm. Why not? And the answer, I think, is excesses and corrections. So you have a trend line, and most trend lines are upward sloping.
Yep.
But then you deviate from the trend line on the upside because of some combination of optimism and greed and wishful thinking, and then you have to have a correction to the downside. So now I'm thinking we may have more of an excess, which leads to more of a correction.
I've thought a lot about this too. I'm a great believer in cycles, and everything I've read in history demonstrates beyond any argument that they do exist everywhere. And, when I think that through, I put that down to a human level. There's a cycle of life, and markets are nothing but the collective representation of our greed and our insecurities and our cycles. And
that's a major theme of the book.
Yeah, exactly.
And
but it's a hard thing to argue that when people, and I've had a lot of people tell me I'm wrong. Cycles don't exist, and you shouldn't really build any kind of investment thesis around them, which I find remarkable.
The cycles come primarily from the behavior of people.
Yeah.
And I don't see how you can argue that people are not prone to excesses.
And repeating.
And repeating them. And the big theme of the book is Mark Twain: history does not repeat, but it does rhyme. And the world is just too unstable a place to believe that stability is the norm. And, if you think about it, in the economy, a great year is up 4 and a bad year is down 2.
Yeah.
So the economy has an upward trend and it kind of goes like this. Then companies have leverage, financial leverage and operating leverage, so their profits go like this, and then the market goes like this. And why? Because of people. Yeah. The risk in the market does not come from stock certificates, companies, exchanges. It comes from people. Yeah. But people are prone to excess, and I don't see how it can be argued otherwise. And by the way, when people say, I don't think we're going to have cycles in the future because the astute Fed has it under control or whatever it is, what they're saying is what I consider the 4 worst words in the world. It's different this time. Okay, until now we've had cycles, but we're not going to have any more.
Well, I mean, your point is so well taken, particularly with the idea that if you misalign the incentives and you offer moral hazard to we human beings, the excesses are just going to get greater because that's what we've always done. Something else that's cyclical is political leanings to left and right, and this is something that's occupied a lot of my time recently, just trying to think all this through. We are at seemingly a remarkable point in history where capitalism is under threat.
Yes.
Now, I would argue that we don't have capitalism anymore. It's something completely different. I think we had capitalism, maybe some of these problems wouldn't be here. But you wrote very eloquently about the move to socialism. Perhaps you could talk a little bit about how you see that, because it's a phenomenon that's everywhere at the moment.
Well, as I say in the memo, I think that in the 60 years immediately after World War II, we had a strongly rising tide throughout the world. And it raised all boats, and most people were happy. Some people did better than others, but just about everybody did pretty well. And the ones who did the best didn't do that much better than the ones who did the worst. So we didn't have the great inequality, and so it was a sanguine environment. And Reagan and Thatcher came along and talked about the wonders of the free market system, and the world applauded. And so that was a swing of the pendulum in that direction. But now the growth, I believe, has slowed. The distribution of incomes is more skewed. It's more important today to have either a good education or capital.
Yep.
And the people with neither, who just have a strong back, because of automation and globalization, I think that we're running out of jobs for them, and that's going to be a big deal in the future. To me, that's the biggest single problem we have in the next decades. Yeah. And so, but especially because of the inequality, and also because now the people who do best do so much better than the people who do worst, that there's a lot of dissatisfaction with the results of this so-called free market system. And so the pendulum in some quarters is swinging against it. And we have a lot of anti-capitalist and anti-capitalism rhetoric.
Well, I mean, you quote Churchill when he talks about that capitalism is the best system, the worst system except for all the others that have been tried.
Well, he said it about democracy, of course.
Democracy, I beg your pardon. Yeah.
Right. But I think it's true of capitalism either. I mean, it has flaws. But one of the things I said in the memo is we must not adopt things because they have benefits without thinking about the costs, and we must not reject things because they have flaws without thinking of the benefits. Yeah. And what capitalism is highly imperfect, and what's better? That's the point. And where are the examples of successful planned economies? I say in the memo that I can imagine the politician from the left railing against capitalism on Facebook and Twitter via their iPhones, right, in meetings they went to via cars and airplanes and maybe ride sharing, in face-to-face meetings over a Starbucks coffee, and over the cable news networks. Yeah. And none of those things would exist if it wasn't for the incentives of the free market system. And so everybody says, the people from the left say, I don't like the inequality, so I want to change the system. But they don't ask how we got to where we are, or what changing the system would do to the future. Yeah. And I think these are important questions. And unfortunately, though, populist rhetoric has an immediate appeal. The opposite, the appeal is intellectual, yep, which is not so easily communicated.
Well, it's very interesting because you put the definition of populist, yeah, in the memo from the Free Dictionary, I think it was. And it was very interesting because I hadn't read that exact definition, because it talks about disenchantment against the elite.
Yes. Well, actually, what it said is the struggle of the people, yeah, against the elite. Exactly. And I said, I think what they should add is the word resentment.
Right. That's right. I beg your pardon.
And it plays to resentments.
But it's interesting because I hadn't thought of it in that context, that populism is necessarily against the elite ruling classes. I hadn't thought of it in those terms, because once you do that, you instantly understand why, right, the rhetoric is that populism is so evil and so dangerous and so troublesome. Right. And obviously people get painted as extreme. Right. You know, there's lots of extreme right-wingers. There's no extreme left-wingers, it seems to me, which is interesting.
Now there will be.
But that's where we seem to be moving towards. And we'll come on to that in a second, but I just want to go back to that income inequality that you talked about, because the thing that always strikes me is there's no mystery about how this has occurred. It's very plain to see how this has occurred, and yet nothing is being done at the grassroots, zero cost of capital level that has enabled this. And you and I could pull up any one of 50 charts, and in any one of those charts, it's plain as day. Is this something that is never going to happen because it's not in the interest of those who make those decisions? Or are they going to start to feel the heat and maybe decide to tweak it a little bit against themselves?
1970, I was a kid from Queens, New York, and I made my first business trip to California. And I was down in Laguna Beach, and I was, I think, speaking with my wife on the phone, and we're talking about how I said, it's so great down here, you know, because you go out, you play on the beach, and there's sunshine, and there's palm trees, and there's sand, and I said, I just probably don't want to be around when the have-nots come up the road.
This is 1970.
Now it's 50 years later. So I was, again, too far ahead of my time, and, right, and thus wrong. But the point is, now it looks more likely that the leftist sentiment will influence the debate. I wouldn't go so far as to think that the next president will be a leftist, but I think that it will, just like Bernie Sanders, I think forced Hillary to move her rhetoric to the left, and might have caused her to move her actions if she were elected. I think that Ocasio-Cortez and Warren and so forth will, and Sherrod Brown, will cause the center of the Democratic Party to cater in some way to the left.
I mean, it certainly seems that way. When you look at the traction that Ocasio-Cortez is getting, and Liz Warren, and it's clear that they both realize that this is how we're going to create that traction, by going against the elite. But some of the things they're proposing, you know, the 70% tax. You know, Liz Warren was on MSNBC looking straight down the camera barrel saying, we're going to find your wealth and we're going to come and get it. Right. I mean, these are things that I'm sure a lot of people in America never thought they'd hear, right, in this country.
Well, you know, I think the thing in the memo that I got heated about the most. And I was trying to put it out, and then Friday, Elizabeth Warren came out with her wealth tax idea. But what got me was that she tweeted it out, of course, and was the way she did it. She said something like, don't quote me, the rich and powerful run America, and look at what they have arranged for themselves. Yeah. They are allowed to keep their accumulated wealth. Well, guess what? We're all allowed to keep our accumulated wealth. And she makes it sound like, through some skullduggery, they have exempted themselves from the wealth tax. You can't exempt yourself from something that doesn't exist. Yeah. But she makes it sound nefarious. And that's populism. They, you know, and it's not constructive. You know, I would lay a strong bet that 5 years from now, my tax rate will be higher than it is today. Yep. But it should be, as I said in the memo, it should be progressive, but not punitive, sure, and not confiscatory. Among other things, people don't have to sit still and pay it. Yep. I wrote a memo back in 2016 called Economic Reality, yep, and I talked about a guy I know who was the biggest taxpayer in New Jersey. They raised the rates to a point where he moved to Florida, yep, where there is no tax. So the point is, the people who want to confiscate seem to think that there's nothing that the confiscatees can do about it.
It's funny because when you look at the two we're talking about, Ocasio-Cortez and Liz Warren, you know, Liz Warren's been around long enough, right, to have seen this experiment tried in the UK, for example, in the 70s. Sure. It was a complete disaster. Yeah. And one would think, brilliant academician that she is, that she's read plenty of history and understands that this really has never worked. Ocasio-Cortez, on the other hand, hasn't been around long enough to have seen it for herself. Maybe she's read about it, maybe she hasn't. But she's also the voice of the largest generation in history, right, who are now coming into the period in their lives where they need to be able to afford homes and afford all the kind of things that we and the generation above us have taken for granted. So you can see the problems. Absolutely. They're writ large.
Yes.
But it's hard to see a way, when the political divide is so extreme, that there's any way that the two sides can figure out some kind of solution to this that doesn't cause some real problems down the road.
Well, my main political activity right now is something called No Labels, the goal of which is to bring the two sides together, yeah, and to act in a bipartisan way. It may be a pipe dream, but I think it's the best hope.
But so how do you go about doing that? I mean, on a practical basis.
Work for the election of, and you support people who will cross the aisle and work with the other side and compromise. And a compromise would, among other things today, be ideological. And yeah, we've reached the point where he worked with the other side is an epithet.
Yes.
But, you know, if you go back to my boyhood, that's what people did, and they produced compromise legislation. So instead now, when you can't work with the other side, what you get is either nothing or legislation which has no support from the other party. Yep. So Obamacare was done with zero Republican support, and the Trump tax package was done with zero Democratic support, and that was the goal.
Yes.
Now, what the hell kind of goal is that? It is un-American to have it as your goal that you don't want the support of the other side. Yeah. And then all you get is divisiveness.
But this is a problem that you know, politicians, that was their art. They could talk to the other side and come up with compromises. Right. But now, if you take it down to a family level, there are families that can't talk politics over, right, dinner table anymore, because sure, they're rabidly on one side. And I kind of observed this as an Englishman transplanted into America, which is a country that, you know, I fell in love with at the age of 10 when I first came here, and it's always been this beacon to me of everything that you would want from the leader of the free world. And everywhere I look, I see this divisiveness, and it's really hard. It's really hard, even if you try very carefully to tread a middle line. And even in your memo, you know, you went to great pains to reinforce that I'm not picking a side here. I'm trying to get people together. Does it take something dramatic to bring the two sides together, or is this something that you think maybe over time will be forced to heal the rift?
Well, No Labels is hoping that there will be a grassroots. You know, we read, for example, that something like 80% of Americans think there should be some gun controls. Yeah. And you can't get them. What does that mean? It means that the politics and tactics of division somehow are stronger than the tactics of togetherness. Yeah. And so it has to be either a grassroots effort, and by the way, things might have to get worse before they get better, but I'm not sure how they can. Well, now that we have a Democratic House and a Republican Senate, you know, we're probably going to have gridlock for a long time. And I've argued in the past that we have real problems that have to be solved. For example, we know that Social Security is going to fail. Yep. There are only a few things you can do. You can raise the tax rate, you can raise the amount of income it applies to, you can reduce the benefits, you can delay the retirement age, you can have a means test. There aren't many more than that. And if you don't do any of those, it's going to go bust. And you don't do anything. What's the last time you even heard about it being discussed? Sure. Because it's not good for politics. And you know, a tremendous amount of our problem has to do with the media and communications. And you know, people say, I only want to hear news that I agree with. And of course, nowadays you can easily find that, yep. Which means that you never hear an argument for the other side. So how can views become moderated? I don't know what the solution is, but I hope there is one.
Well, I mean, but at least we've identified the problem. I guess that's the first step. But, yeah, the memo was called Economic Reality Meets Political Reality.
Well, the other way around.
Yeah, sorry, no, you're right. So let's talk about the economic reality of this, because the political reality is, you and I are never going to get to the bottom of this in the time we have. But the economic reality, how do you take what you've observed on the political scene, you take what you've looked in terms of asset prices and valuations, and you take what you've seen from the Fed and the interest rate cycle, how do you apply that to your investment philosophy right now? Has it changed anything? Has it made you adjust anything?
I think that, Grant, the most important decision for an investor at a point in time with regard to the intermediate term, by which I mean not tomorrow and not 30 years, yeah, but the next 2 to 5 years, the most important decision to make today is whether to invest aggressively or defensively. And it's not all one or all the other, but how do you mix the two? You know, an investor like me faces two risks every day. The obvious risk that everybody knows about is the risk of losing money. The other risk, which is a little more subtle, is the risk of missing opportunity. And so what most people say is, well, I don't want to lose a lot of money, but on the other hand, I don't want to miss all the opportunities, so I'm going to do something that compromises on the two. And each person's positioning vis-a-vis the two risks should be different based on their circumstances. But still, then that's the first question. And then the second question is, you figure out your normal risk position, and you look at today, and you say, well, today, should I be worrying more than usual about losing money or more than usual about missing opportunity? And you know, I just think that the world is an uncertain place, and the things we're talking about contribute to the uncertainty. And so today I would emphasize avoiding the loss of money a little higher than usual vis-a-vis avoiding the risk of missing opportunity.
Everywhere you look across the financial landscape, there's a series of successful and importantly pragmatic investors who are coming out and issuing what the headline writers call stark warnings or dire warnings. Seth Klarman being the most recent, perhaps, during the Davos thing recently. That I'm always interested that cacophony of voices that gets louder and louder and more respected by the day doesn't seem to change behavior at all. We seem to be in this period where, to your point, that fear of missing out is being re-weight adjusted by the smart investors, the guys who are always early, and yet the retail investors are wiping their brows and saying, well, December's over, Kramer said the market's going to go up, we should investigate the dip on Christmas Eve, everything's good again. When you look at the way average retail investors think about this, do you really want to find a way to reach out to them and say, listen, you need to think about it like this, you're not thinking about this correctly?
It's a tough one,
Yeah.
Grant, because, I always imagine, the movies that are made for the teenagers. And over here, sitting on their shoulder, you have the angel saying, don't do it, it's not prudent, you'll regret it in the morning. And over here you have the devil saying, do it, it'll be fun. And the devil wins.
Every time.
And then that's why we have the movies.
Right.
But in the investment business, you have prudence and history and knowledge of cycles and consciousness of the risks. And over here, the devil says, do it, you'll get rich. And wishful thinking, the desire to get rich is really dominant, and the fear of missing out together. And so we saw in the fourth quarter an incredible swing of psychology from positive to negative, but then back. And most of the damage has been made up. Most people don't invest in the long term. They're just trying to bet on what the market's going to do. The retail that you described, but also many professionals,
yes,
because they're afraid to be cautious and miss a good month,
yep,
because they could lose business. It kind of goes back maybe to your first question, which is that most people are afraid to be wrong. And since the market goes up most of the time, being wrong consists of being out, which means most people are afraid to be out. And so their nature doesn't permit them to get out until
it's too late.
Until the crisis is upon us.
Yeah. So you talk about the volatility we saw in December, which is the first such volatility. We had a brief breakout a little while ago that got squashed quite quickly. But this is the first. We've seen 500 and 800 point moves down in the Dow, which has come as a surprise to a lot of people. But do you think something has changed? Do you think what we saw in December is an early indication that we are moving into whether it's a pause phase and the market's going to find its new course, or we've reached the top and maybe we're going to bumble around here for a while before going lower?
One of my favorite quotes is from Einstein, who said something like, I don't think about the future, it'll come soon enough. I don't try to guess what's going to happen. I just try to make good fundamental investments. And they tend to take care of themselves either soon or later. But, what you had was a crazy swing of psychology. One of my favorite memos was in February of 16. Remember, the market got off to a terrible start. And I wrote a memo called On the Couch, because I think every once in a while the market needs a trip to the shrink. And I said in there that in real life, things tend to fluctuate between pretty good and not so hot. But in the market, people act as if they go from flawless to hopeless. And that's what happened in October. My new book came on October 2nd, and I can tell you that the mood was quite good. And, in the months and couple of years leading up to October 2nd, the main comment I got from people was, well, we know it can't keep going on well forever, but we can't think of anything that'll make it stop.
Right.
And that was true up to then. And then on October 4th, the market decided to go down. And it went down for the next 80 days in one of the worst declines that's been seen in a long time. We had, I think, the worst December in history, if I'm not mistaken. So what changed? And my next memo may be on the subject, because I've been storing up thoughts. But fundamentally, not much changed. I mean, what was it that made the market start going down on October 4th? Well, they said, the 10-year just hit 3.25. But of course, it was expected, rates were expected to rise. Oil was weak. Well, I don't think that's really of great fundamental importance, because it's actually good for society when the price of energy goes down. Well, there may be a trade war with China, but that you could see coming for 9 or 12 months. So nothing really changed except for the mood. And I think the mood is absolutely unpredictable, so I don't even think about that. And fortunately, I don't make my business that way.
It's interesting because that hearing you say that it makes me realize that's exactly what most people do. It's all about mood. They have it completely flipped around. They gauge sentiment. They chase momentum. Yeah. And to your point, it's not just retail investors. It's a lot of professionals. For some of them, against their better judgment. But we all have to try and manage risk. To me, first of all, I've been a trader my entire life. So for me, the first thing is always the risk. It's not the opportunity. I always look at the risk and think, okay, once I'm comfortable with the risk, then how is the best way to play the opportunity? Is there a time when you shift the way you think about making those longer term investments? Do you have to, is it fundamental investments, fundamental practices behind them that are constant? Or do you find that when you get to certain points in the cycles that you follow so closely, you have to shift the way you assess risk and opportunity?
Well, remember what I said, aggressive, defensive.
Yeah.
So sometimes.
So it's just that.
Yeah, sometimes. But it's often a bottom-up thing. See, because it's not like, well, you find a bunch of investments and sometimes you decide to go heavy and sometimes you decide to go light. What it is that sometimes you find a lot of great investments and they tell you that this is the time to load up the boat. And sometimes you can't find any bargains and they tell you this is a time to be defensive. So it's not an independent decision, you see. Now, a lot of people make that decision top down. They look at the macro, they look at the number technical and all the trading numbers and all those things. And I look at the mood of the environment. I look at how people are acting and thinking and talking, and that tells me also whether I should be aggressive or defensive, as I described in 05-06. But it also comes through in the investments. You find things that you say, well, I think that's half what it should be. I'm going to load up the boat. So you turn aggressive. But for the most part, you don't get many of those opportunities when the market is galloping along and everybody's optimistic and risk aversion has gone out the window. So it's all of a piece. But I do think that it's desirable at the extremes to alter your behavior. Now, I was working on the book and I gave some chapters to my son to read, who works on our family investments. And I told him, I think my market calls have been about right. And he said, yeah, Dad, that's because you did it 5 times in 50 years.
Right.
The point is, and I didn't even stop to think about it that much, but of course I thought about it in this later days. But when you are at an extreme high or an extreme low, the logic is compelling and the probability of being right is high. But when you do it in between, the market's 5% overvalued, 2% undervalued, 10% overvalued, the logic is not compelling, and the probability that you're right is modest at best. So 5 times in 50 years, once a decade. Yeah. And that's what we tend to get. We tend to get one of these and one of these a decade, but these are not always extreme. And so you can't make a career out of playing the extremes of the cycle, but they can inform what you do. And you can modify your behavior in between, but you shouldn't count on being right.
It's the perfect way to wrap this up. Howard, thank you so much for doing this. I've been waiting to talk to you for such a long time, and it's been everything I hoped for and more. So thank you for being so generous with your time.
Pleasure for me too, Grant. You made me think about some things I hadn't thought about.
Well, that's a feather in my cap. I take that proudly. Thank you.
Pleasure.